Banks are changing from investments to public utilities. But what does this mean? How does this affect you and me? Now, this shift that's changing deep inside the U.S. financial system, it's causing institutional funds, or what we refer to as the smart money, to change their entire playbook for next year and beyond. And in this video, I'm going to break down what's happening with the U.S. government, the banking system, and what the institutional investors are doing. And if you act quick, you can join them in their own game. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I like to say that the world's changing fast. And if you're not paying attention to see these shifts that are happening, you might not realize until it's too late. And since no one's coming to save you, it's up to us to figure this out and navigate this on our own. So if you like this type of information, and of course, you want to help me get it to more people, please just take a second, hit that like button. If you're not already subscribed, hit the subscribe button and the bell notification to know every time I put a new video out. Now, today, we're talking about what's shifting deep inside the financial system. And we can see it if you're looking at the dollar. Now, of course, the dollar is the world's reserve currency. And right now, the dollar's value, it's falling fast. In fact, when you look at the DXY, we call it the Dixie, it's the chart that shows, it shows us the value of the dollar compared to a basket of other currencies. And then when we look at that, we can see that the value is starting to fall pretty fast. It's falling sharply, it's falling fast. And what's important to know about the dollar index crashing, the Dixie crashing now, is how fast and how far it's fallen. Now, we can see another big crash in 2016, but what's important to look at from that crash to now are a couple of things. One, in the 2016 crash, it took twice as long to crash. All right, so we've crashed in half the time, much faster. The other thing in 2016 is it was a coordinated event called the Shanghai Accord. All right, now this time it's crashing because investors, institutions, and sovereigns are dumping it because they don't want to hold it anymore. So it's not coordinated plan like it was before. Now people are getting rid of it because they don't want it. Now, these concepts, they're complex, and I can't really dig into all the nitty-gritty of it, but I always like to boil them down to the most simple concepts, which is always supply and demand. All pricing starts at supply and demand, and of course, when nobody wants to hold dollars or treasuries, there's no demand for that, and there's a lot of supply, so we have nobody wants to hold them, they're dumping them, and we have a lot of supply. What happens, right? Of course, the value goes down. And of course, the reason why they don't want to hold them anymore is because everybody knows that if the US doesn't print trillions and trillions and trillions of dollars next year, it's going to literally crash. They know that. Everybody knows that. Now, in 2020, we saw the US government budget deficit, which is the amount that they're short on the budget. We saw that amount triple to $3.3 trillion, which, just for a little perspective, the income of the government, which is the tax receipts, the income for the federal government is estimated to be $3.42 trillion in 2020, which means the government's basically spending twice the amount of money that they're bringing in. And of course, the future's not looking any better. In fact, per the CBO, which is the Congressional Budget Office, they estimate that we could see the deficit, the amount we're short, the deficit double over the next 20 years. So we're not going to make ground on it. As a matter of fact, it's only going to get worse. Now, in my opinion, that's a pretty conservative number. And of course, with the increasing deficits, this means that we have increased borrowing, we have increased money printing, and increased inflation, which of course, inflation steals value from anyone that's holding dollars. And because of this, sovereigns and institutions who hold billions and even trillions of dollars in the form of treasuries, they're losing their faith. They're losing their faith in the reason to hold the dollars because at the current yields, basically at near zero, there's no reason to hold them. So in other words, low interest rates on treasuries, they've killed the investment returns across traditional parking spots for these big volumes of money. Institutions don't want them. I mean, why would they hold trillions or hundreds of billions or trillions of dollars that have no interest, no upside, but have massive risk, have a high downside? That's not a trade that I would like to make, and they certainly don't want to do that either. But of course, as I said, with the deficits, the U.S. needs capital, and it needs it really, really bad. Now, like I said, when we looked at the deficits that the governments are running right now, and of course what they're forecasting for the future, we see the need that they're going to have. So who the heck is going to buy up all this debt, right? Who's going to buy it? The sovereigns, the institutions, they're dumping it. And we know we're going to need more of it, so who is going to buy it? And of course, the answer is the Fed. That's right, the Fed, and not just the Fed, but also the financially repressed U.S. banks, which are already and are going to continue to look more and more and more like government utilities, which is what I was talking about at the beginning. And we're going to see that they're only being used as a extension of the Federal Reserve, of the government, to continue to get the financial system working. And these banks who used to invest for profit, investment banks, they're going to be forced to just buy and hold treasuries, and they're going to be forced to buy and hold government debt on behalf of the government, bringing their profits down just like a utility would be. So if the institutions are going to be forced to abandon the treasuries because there's no meaningful return, and of course, like I said, massive downside risk, where will that money go? Okay. And in my opinion, there's two places it's going to go. Now, first, we're going to see those institutions or sovereigns move that dollar. They're going to move it to TIPS. All right. TIPS are Treasury Inflation Protected Securities, which means that instead of just holding to the dollar with potential interest, but they're losing it to inflation, they move it to something that pays a little bit less interest, but it's protected against inflation. It's indexed to inflation in order to protect them from losing that purchasing power. So as inflation rises, the TIPS, they also adjust in price to maintain its real value. The second place that it's going to be going, the money is going to be going, is of course gold, and by extension, royalty plays, big miners, intermediaries, and juniors. Now, it's going to go there because of their superior risk and reward alternatives. Now, I wouldn't advise any of us to buy TIPS like these institutions do. Like I said, it's a place where institutions can safely park billions and billions of dollars. But for retail investors like you and I, we can just park it in a bank. We can put it in an FDIC, insured account and things like that. But we can follow the institutional lead into gold. All right. Now, just as a side note, real quick, I did recently mention in a previous video that we're starting to see some institutions moving into Bitcoin as well, but that's just a tiny drop in the bucket compared to what is going to be moving into gold. As I referenced in that video, I said that currently Bitcoin is only 3.5% of gold's market cap valuation. So gold is the big market, all right? Gold is a market that can take those hundreds of billions and trillions of dollars. Bitcoin can't, all right? Also, gold's been money for 5,000 years. And while gold has been in what, we call this consolidation pattern for the last couple of months, I think between now and the end of the year, bargain hunting season for us is here. Now you can see every year in late November and early December, gold share prices consolidate, and we see many company valuations find the bottom, or what we call the floor. And this gives us as investors a great opportunity to pick up these great names at a discount. Now, a big reason for year-end weakness is because of something called tax loss harvesting. All right, and tax loss harvesting happens every single year. And the reason why is because, stocks are going up and down. So what we see at the end of the year, November, early December, when the tax year is ending, many holders, they sell their winners to go ahead and book profits for the year. But at the same time, they want to sell their losers to capture those losses at the same time. And so the losses can even out the profits. And they do this so they can lower their tax base, all right? So every November, December, we see, lots of very well-run companies experience this kind of sell-off just because people are locking in gains and they're also taking money off the table at the same time. Now, in many cases, there's nothing wrong with the companies. It's just that the shareholders are trying to move cash around, trying to finish this year-end accounting. And this holds the opportunity for us because we can buy some excellent companies and into excellent funds at really good prices, which is perfect because I expect in 2021 and January, we're going to start to see a big rally for precious metals. And I believe it's going to be driven by the rise in the value of gold, silver, and other hard assets that all this money is going to be flooding into. Because as the US and the other central banks of the world print trillions and trillions of dollars of fake fiat currency, it's going to drive more and more people to buy these real hard assets. Now, this is the big picture. This is the macro picture for gold and silver, and even other types of metals such as platinum, copper, and several other base metals as well. Plus, we're going to see great moves for technology metals, which may be a new term to you. I've been talking about it a little bit recently, and it basically means like rare earth minerals, rare earth elements, and they're critical to things like batteries, electric cars, electronics, defense equipment, aerospace, things like that. But the point is that there's going to be big moves coming for stocks that deal with rocks, and definitely you're going to want to position yourself to take advantage of that. Now, buying gold, it's relatively easy for most people anyway. I do get a lot of comments asking how to buy gold. Leave me a comment if you want to know more about that. But it's pretty easy. There's lots of dealers, lots of local shops that you can buy. There's several online reputable dealers that can ship it to you. Some can even store it for you in their own secure vaults. Now, I think we could see gold's price rise from today somewhere in the 1850-ish range. I think we could see it get to 2,300, maybe 2,500 just in the next several months, which is a pretty nice gain from here. But if if you want to get big gains like 10, 20, 50 times returns on the physical gold's price, then I like to look at gold miners. So let's say if gold goes up, say $300 or $500, I mean, that's pretty good, right? But for a gold miner could have 1 million, or they could have 5 million ounces in the ground. So instead of making $300 or $500, that's $500 times 1 million ounces, which of course is a massive, massive move. Now, the easiest and safest way to play this is with big, well-known large cap miners. And the easiest way to play this is using like a gold miner ETF, something like the Sprott Gold Miners ETF. It trades under the symbol SGDM. And when you buy that, basically what you're buying is you're buying a basket of big, well-known gold miners, companies like Barrick, companies like Newmont, things like that. All right, so you can just buy them with one click and get exposure to that whole thing. But if you want to do better than buying the ETF, then I like to buy the individual companies, the ones that I think are going to do the best. So for example, you could buy Barrick directly. The symbol is GOLD. Now, if you're not familiar with Barrick, they're one of the largest gold mining companies in the world. And they jumped from basically maybe an unknown name outside of the gold mining space to almost a household name when one of the biggest and most famous investors in the world, Warren Buffett, announced that he had bought a big piece earlier this year. And that was really big news because if you followed Warren Buffett, then you know he's been pretty outspoken against gold. And so, of course, it shocked the world when he came out that he had bought into Barrick. And as I said, they are one of the largest gold miners in the world, and they're one of the safest gold positions that you can take. In fact, they just retained their listing in the prestigious Dow Jones Sustainability Index. And they ranked 95th percentile of all mining companies assessed for the 13th year in a row. All right, now there's lots of factors that contribute to this, but they've been one of the best performing companies. Now, it is worth noting that they are down about 20% from the high that they set back in August. But that's because gold's down. Gold's also down about 14% from its high. But of course, if you've been paying attention, it has seemed to find a bottom and it's starting to bounce back up. Now, if you want even bigger returns and then you don't mind the more risk that comes with it, then doing something similar, but in the junior mining space might be a better option for you. And maybe both. Maybe you take some of the big and some of the junior. Now, in that case, you can get exposure to these well-run group of junior mining plays, kind of the same way. There's also a Sprott Junior Gold Miners ETF. It's on the NASDAQ symbol SGDJ, and they hold a collection of junior players, right, with names that you probably don't know. Now, again, if you want to do even better than buying the basket, the ETFs, then you can look for individual companies to own, which of course adds more risk, but then you get more reward potential, right? So probably on the opposite end from Barrick, one of the biggest companies, we can look at some small companies that are, names that you probably don't know. Maybe a company like Blue Lagoon, symbol BLAGF. Now, they're working really, really hard to bring new gold reserves to market, and they're much smaller, which means they're much more risky, but they also have way more upside potential. Now, a company like Blue Lagoon, they've recently acquired a piece of land, about 46,000 acres in what they call the Dome Mountain Gold Project. It's an all-year accessible property located in British Columbia. They already hold permits, the Environmental Management Act permits, the mining permits for like 75,000 tons of production annually. They have 15 well-known high-grade gold veins, and they're starting to drill next year on this newly acquired property. Now, if it all works out well, investors are going to be rewarded nicely. But of course, at this point, it's still unknown, which is why, of course, it's way more risky than Barrick. But the potential trade-off is that there's way more upside. All right, so you need to make sure that you know the risks, and then you need to manage your risks and your position sizes accordingly. All right, now in any case, for 2021 and beyond, gold is going to continue to do very well as more and more institutions dump their treasury holdings and move assets into gold. So whether you buy physical gold, whether you store it in your own safe, whether you want to take a stab at one of these ETFs, or try to buy some of these individual gold miners like Barrick or Blue Lagoon, like I mentioned, in either case, you're going to be in the proverbial boat that rises with the golden tide. Now, I really like the small cap space because of the risk and reward. Now, if you're interested to find out how to find and value gold mining stocks, you can access my free gold mining report. It's linked in the description of this video. And in it, I just break down the criteria that you need to look at to find these companies, how to value them, how to forecast where they're going to be in the future, and things like that. And you can get it for free, and it's linked in down below. Now, gold It's going to preserve your wealth over time. And mining plays are derivatives of the straight up gold price. And that's why I like it. All right. Now that's what I got for you today. Give me a thumbs up on this video if you like it. If you don't like it, give me some thumbs down, but leave me a comment down below and let me know what you think. Are you going to be taking exposure to physical ETFs, or do you like to play the miner plays directly? Let me know. I try to reply to as many comments as I can, at least for the first couple of days. And that's what I got for you today. To your success, I'm out.